Okay friends, welcome to part 3 of our tutorial C. In this tutorial we'll talk about the skeleton, meaning the Excel sheet that you can use as a base for creating the decision support system for the thrift shop described in tutorial C. This skeleton can be downloaded from Canvas. I posted that file there so that you don't have to deal with like formatting and some basic data entry problems. So let me give you an overview of this skeleton sheet. So once again, you're trying to build a decision model or decision support system so that you can understand better various scenarios in relation to borrowing money to finance expansion of your thrift shop versus not borrowing. Okay. One technical comment: virtually every cell in this Excel sheet is formatted as currency. So if you right-click on each cell, on any of those cells, and go to Format Cells, you will see that it's a currency with 0 decimal places. So we don't want to have this kind of 0 precision. So you see, currency, has a dollar sign, and also negative numbers are represented in parentheses in red using red font. So this is like a loss of $1,234. But of course, not all cells are are of currency type. Some cells are percentages. So if you check this cell, you'll see that this is a percentage with 0 decimal points. So basically, right now you are in 2015, and you have some basic sales data from this year, and you'll use this basic data to estimate future scenarios. So let's look at some of the sections of this decision support system. The first section deals with constants. Now, constants, those are parameters that don't change. Okay, those are the things that you want to keep constant. So one of those things is the loan amount, which is $100,000. Now, perhaps you decided to keep it constant because this is the loan that you need, or this is what the bank promised you to give. So in other words, there is no much room for maneuvering around this amount. So it's $100,000, and that's it. Okay. The other thing that you wish to keep constant is tax rate. Again, something that you can be fairly certain about. No matter what happens in the external environment, there will be a tax, right? And you're kind of making that assumption that in the first year it will be 33% tax rate. In the second year, because you're kind of thinking that no matter what, your business will grow, either you expand or you don't expand, regardless of the economic conditions, your business will grow, and because of that you'll have like a slightly higher tax bracket, because this is how tax system works in the United States. Is the so-called progressive tax system, where the more you make, the more money you earn as an individual or as a business, the more you pay an income tax as a percentage of net income or revenues, right? So you're assuming that the tax rate will grow, right? So those are your constants, those things that they're assumed to kind of remain the same no matter what. Okay. Now the second section is called inputs. Now those are like some of your main parameters. So basically here you can enter various expectations for next year, and here it looks like there's an assumption that those expectations will continue for 2017 as well. So the first parameter that you will enter is economic outlook. R for recession and B for boom. So you can enter either R or B in this cell. Okay. So recession means you project that the economy in 2016 will decline, meaning people will have less earnings, businesses will have less sales, there will be higher unemployment. Now those are bad things for the society as a whole, but those are positive factors for your own business, because your business has the so-called negative correlation with the economy, meaning if the economy is doing well, your business is not doing well. But if the economy is suffering, then your business is doing well, because people go for those used items, right? If economy booms, then it's bad for your business. If you put B, it's bad for your business, because when everybody is doing well, when everybody has money, then they're less likely to buy used goods, like used clothing or used items from your store. But in your case, you are kind of projecting recession. And then inflation outlook, high or low. Inflation means money losing value. So for example, if this year in 2015, on average hamburger cost $2, and then let's say next year on average, the average price of a hamburger in the United States is $2.05, it means there is an inflation of what, 2.5%, right, per year. So in other words, your money is losing value. You're losing value because of there is a greater currency mass out there. Let's say the government is printing additional money, or it also happens during economic boom where people have more money on their hands, so that because of that the prices will go up a little bit, and this is how inflation is created. But of course, it's a very naive, superficial explanation of the inflation. There are so many other factors that come into play here. Okay, so you have recession, and then you have outlook for inflation, high or low. So the book asks you to put H, I believe, right? Okay, so this is the input section. Now this section is summary of key results. Now this section is not very complicated because basically it replicates other sections. So what are you trying to do? You're trying to create a section here that gives you a very high-level summary of your financial situation, giving various inputs and various scenarios, whether you borrow money to expand or you don't borrow money to expand. So basically it's like a summary, right? Because it's a summary, it will just draw numbers from somewhere else, from other parts of the Excel sheet, okay? And here you're doing calculations. Those are, this is the part where you're doing some calculations, right? So here you don't do any calculations. You just provide inputs, and here you just summarize some of the key indicators. But in those calculation sections here and here, you're doing actual modeling, actual data modeling and projection. Okay. Now there's one thing that you need to understand. You see, like some of the calculations are done here in those parts, and then whatever you came up with in those parts is transferred to those parts. Like for example, total sales, cost of goods sold as a percentage of sales. Here you have interest rate for business loans. Again, you don't have it for the no expansion option because you won't borrow anything, you won't pay any interest. Okay. Now, something that you will see later on, once you understand all those calculations, that those calculations can be done as a part of these sections. Okay. So if they could be done here, like we could add like cost of goods sold, we could add interest rate, we could add cost of goods sold as a percentage of sales right here. So the question becomes, why are we doing those calculations here? Well, a short answer is just to make things simple, because if you include those calculations here as well, then you make this section unnecessarily complicated. So you kind of separate, you divide your calculations into small islands so that your calculations become more manageable and easy to understand. But there's little that prevents you from doing those calculations here. So what you're calculating here, you're trying to estimate total sales in dollars, how much you will sell in a particular year, 2016, 2017. And then you're trying to estimate cost of goods sold. Now, cost of goods sold means like the cost of goods, right? And it's not just like, to be honest, I forgot the exact accounting definition of cost of goods sold. You can easily look it up in the web, but it has a very precise, regulated, required definition, what's included in cost of goods sold. But basically, from what I remember, it's not just the purchase price of those used items. It's also like something related to storage, handling. I don't think it includes selling general and administrative expenses. Like it's a separate item, meaning like marketing expenses, salaries of employees. But basically, it means like how much it costs for you to acquire those goods. Okay. So if this is the cost of acquiring goods and it's estimated based on percentage, what you're saying on average, this is my rough estimate. If I sell something, 70% of that is cost of goods sold, and 30% is like my profit, my earning on that. Why is it expressed as a percentage? Now, think about it. It makes sense because you cannot do those calculations for every item, because like one item can be a bicycle, the other item can be a toy, then the third item can be a dress, and each of them will have different cost of goods sold. It will have different handling. So you don't want to deal with this kind of complexity. You just want to have like an average number. You're saying, well, on average, like giving all those things that I carry in my store, 70% of my sales are devoted to cost of goods sold. So in other words, there's like you can call it like 30% profit margin on average, on everything that I sell. Okay, so those are cost of goods sold. Those are revenues. So from that, you can roughly calculate your income before tax. And here you're doing the same calculations in the event where you don't expand, you don't borrow anything. You see the difference is that here you have interest rate, a parameter, here you don't. Because if you don't borrow anything, you don't have to worry about interest rate that the bank is charging you. Okay? Now here in this part, you're doing actual calculations about income statement and cash flows. Now, income statements and cash flows are very important financial documents. The third document that is missing from here is a balance sheet. Okay. So balance sheet, income statements, and cash flow statements are typically required documents that any publicly listed corporation needs to produce for its shareholders. Now, of course, here we have a very simplified version of income statement and cash flow statement. It's simplified because it doesn't include like all those parameters that typically go into cash flow statements and the income statements. And then they also kind of combine together. Income and cash flow statements are combined together because there is a lot of similarity between between the concept of income and the concept of cash. However, there is one thing that you need to understand, and this is something that a lot of people kind of find counterintuitive when they take a course in accounting. Income is not the same as cash. Okay, so for example, when you say that this company made an income of $1 million, it doesn't mean that there's $1 million in cash sitting in their account or sitting in the drawer of the CEO of the company. So cash is not the same as income, because income, the way you record income, you do it sometimes on a non-cash basis. So let me give you just like one simple example of recording a transaction on a non-cash basis. So let's say you sell, you're running a car dealership, or you're running a store, and let's say you sell like a truck, as a part of your business to somebody. But you sell this truck on credit, and let's say the kind of credit terms you have is that the person who bought this truck will pay you the full amount by the end of the year, 1 year from now, something like that, right? Just to make it simple. Of course, like real financing is more complicated than that. But let's say you hope to receive the full payment from the customer 1 year from now. So basically, you sold the truck, but you don't have any cash for that truck yet. Yet, accounting rules would typically require you to record that sale as a profit. In other words, you will add to your income statement a sale of, let's say, I don't know, $50,000, because that's the price of your truck, right? So you will record it as your sale, and then you will calculate cost of goods sold, and then you will say, well, let's say cost of goods sold is 80% of sales. So you will record, well, I made a $10,000 profit on the sale of this truck. Yeah, you made it in your accounting records, but you don't have that cash, right? You don't have actually $10,000 in your bank account, because the person who bought this truck will only pay you 1 year from now, okay? So that's the difference between income statement and cash flow statement. Income statement records income as required by accounting regulations, and cash flow statements deal with cash. How much cash you have on hand, how much cash is coming in and coming out. And sometimes even very successful businesses that have like a good, booming business, they're selling a lot, they have like some kind of cash shortage, meaning like they're doing well, they're selling things, they're expanding. However, they don't have enough cash at this present moment to finance their operations, to meet their short-term payment obligations. Let's say to pay employees, to make payments for rent and utilities. So in that case, they would go to a bank and they borrow some cash, against their future earnings, to make sure that they don't have like some kind of technical bankruptcy situation where they cannot meet their immediate obligations. But again, if you want to learn more about cash flow statements and income statements, go to Wikipedia. I think they have very good articles describing what those things are all about. But the idea here is that you want to look both at your earnings as defined by accounting regulations and at your cash flows. And you want to look at those statements given the kind of scenarios that you have in mind about economic outlook, inflation, and whether you borrow money for expanding your store or not. Okay? And once again, those things are required by, you're required to produce those income and cash flow statements by the bank. Again, bankers, they may not have 100% confidence in your model. However, they want to see like some kind of estimation. They want to make sure that you think, as a borrower, you think about various scenarios and you understand what kind of possibilities you have for the future. Okay. So once again, here I try to give you like some kind of conceptual background about this example, about this decision support system. I talked about various sections of the skeleton, and I also talked about some of the conceptual, some of the concepts in accounting, behind this decision support system, as well as some assumptions, some parameters that you have and that you will, change to see various possibilities. Okay, so that concludes part 3 of our tutorial C. So thank you for listening.